All right, welcome back. I told you Bill Baruch's been making a number of moves, which is why he joins us now on the telephone. Thank you for joining us again. I'm going to start with this trimming more small cap ETF, the IJR, which you made the point last week when you first told us about the move that it had underperformed the IWM, right? Small caps had done great. IWM had better reflected that than the IJR, so you were lightening up your position there, and now you're doing it more. Just give us more information on that.
Yes, we leaned into IJR, and I think the small caps have had that risk-on thrust, but the IJR underperformed. So we were very overweight. We're trimming this back to get back and wait for where our model traditionally is. So the other thing that really stood out Friday is the jobs report was not as bad as feared, and we're starting to see, some idea here that's pushing back the rate cuts. And if we're not going to get the rate cuts front-loaded in the first half of the year, then small caps case is quite a bit weaker than it was, say, a month ago.
I mean, are you painting this as more portfolio management or fundamental changes that make the story not as good as it was? Because it sounds like I'm hearing a little bit of both.
I think this is definitely more portfolio management. I think the small caps still have a case, but I think the money is better allocated elsewhere rather than being overweight small caps right here, right now.
Like where then?
So we bought IYM, and talk about a big, beautiful breakout. This is the materials ETF, and I like what we're seeing here. Now, on the show last week as well, I talked about rebalancing our gold miners as well as our CEF, the gold and silver physical ETF. And there are miners in this ETF, but you also have other things in the materials space. You have chemicals. You have Freeport-McMoRan is also a top holding in there. So this chart looks absolutely phenomenal right now. So we're dipping our toes in here. We got about a 75 basis point allocation, and I want to increase. I want to be surprised to see a little bit of a back test of this breakout, and I want to continue to lean into this. I think this is going to be a great story for 2026.
Okay, you bought Tesla. Tell us about that one.
Yes. So we did sell Tesla November 21st. I'll call myself out. It maybe wasn't the most opportune time to sell Tesla, but we put the cash elsewhere like Micron and things like that. Now, what Tesla's done since I exited, it went basically straight up. And it shows this is one of the greatest momentum stocks there are, and there is some momentum behind it. Now, it pulled back last week after the CES conference when NVIDIA unveiled their open source autonomous platform. And now Tesla, I think, has a knee-jerk reaction down, and it tested a great level of support, a trend line going back about a half a year to those lows. And what I really, really like here is I think we're in a risk-on environment. I think you need to own names that are going to help stoke this breakout in the S&P 500, and I think Tesla looks phenomenal for doing that right now.
You just made a mistake selling it when you did. That's the bottom line.
I did. I called myself out about it, but I had reasons to believe. We repurposed the capital and things like Micron that are up 50, 60%, since buying it. So I'll take it.
Okay, that's fair. You sold McDonald's and you sold Workday. So we have a lot of conversation on this desk about software, obviously, but give me the McDonald's one first. Why are you selling that?
I like the name. I like the franchise model. I just think right now is not the time to own it in the portfolio, and I was trying to get cash from somewhere to buy Tesla. It was towards the bottom of our portfolio in a different environment, maybe towards the middle of the year. I see me owning this again. I like the name, but you know what? It had an attempted to break out, and it failed. It's sort of a very lukewarm chart. As for Workday, software's done fairly decent, and I thought maybe we saw some tax loss harvesting in December for software, see a bounce back. Even the mid caps and the small cap software names have done all right. But Workday has not done what we've expected. It's actually really, really on the lows of over the past year and a half. And I'm fearful that it's going to break new lows. But also, again, the capital is better put somewhere else, and that's what we use to buy Tesla.
All right. Bill, thank you. Appreciate that very much. That's Bill Baruch joining us to document the trades. I mean, it's the challenge with software, man.
Software looks pretty lousy right now. Workday, him selling out of it near a 52-week low is clearly understandable.
Yeah. Microsoft can't catch a bid. I mean, it's just dead.
I mean, you have some select calls in the group that continue to like the snowflakes and names like that. But I just can't get out of my head what Brad Gerstner told us, a week or so ago. He looks at the list of the names that are down a lot, and he said 90% of the ones that are down deserve to be down. That's a shocking statement when you look at the declines in some very popular names, and maybe, at least in that investor's mind, they deserve to be there.
The one that's interesting today, it's up 2.5%, is Oracle, trying to make a little bit of move above $200. Follow that one.